Okay. Hello, everybody. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey, hey.
It's shortly after 10 a.m. Pacific on Friday, October 10th, 2025. Fall is well underway. Hope everybody's getting prepared for the holiday season coming up and enjoying the change. Definitely looking at the tail of the ticker tape for the week. It was somewhat of a sanguine week in the markets with stocks reaching all-time highs, but some news today has kind of reversed that entire story. So 4 days of incrementally positive performance wiped out in a day of red. Looking at the S&P 500, for example, as we sit here recording this podcast, it's down about 2% on the day, which would leave it on the week. Let me refresh my indicators here. Down about 1.7% on the week. And when you drill into that and look at some of the sectors, what you see is, consumer discretionary down over 3% on the week. Communication services down over 2.5%, technology down over 1%. Pretty much red across the board, except for the lone holdout there. We have I'll correct myself, two holdouts. We have consumer staples up about 0.5% on the week, and good old utilities up about 2% on the week. So those are your two spots of respite in this kind of tariff fear induced sell-off. Just to kind of give context for this sell-off, the first 4 days of this week were positive were positive trend in the stock market, but today, Friday, there was some news of an escalation in the trade fight between the United States and China, and it really circled around a new rare earth exports tariff that China was going to put forward. And the details are kind of complicated, but it basically comes down to if more than 0.1% of your good or service comes from a rare earth coming from China, there's now going to be like a license and export control. And that impacts all of the major semiconductor firms out there, that are making chips basically because they need more than 0.1% of the value of their goods comes from those rare earth elements that are imported. So it's definitely a heat up in tensions. And then there were some tweets by the president of the United States around that, and it just caused this big sell off. That was the catalyst there. So
Yeah, we got the Qs down over 2.6% right now. Definitely hitting that on the tech side, as you're mentioning there.
that's the kind of locus of concern is this trade war really gonna be phase two of the trade war? The Liberation Day trade war was clearly a big scare for the markets. We had that big sell off in April, but then the rally back, and we settled into somewhat of an equilibrium. But now here we are, and Trump and President Xi were supposed to meet in a few weeks, but I don't know if that'll happen anymore. Anyways, we'll keep you guys apprised, but that's just that's the catalyst for the sell-off that we're seeing in stocks right now. If you drill in and look at some other ways of looking at the market, everything's pretty much down. So we'll leave it there. Moving to the bond market, though, you definitely have some places to hide. You were seeing a nice rally in treasuries currently. Um, the 30-year treasury is up over a point. The 10-year US Treasury is currently trading about 4.05% yield. So that's a pretty big rally, on a week-to-date basis, in about 7 bips, 6 to 7 bips on the 10-year. So that's pretty strong performance. You see that in the fixed income market. The US aggregate is on the week up about 1/3%. We'll see how it closes on the week, but you definitely able the kind of risk off aspect of bonds is being shown right now. One data point doesn't make a trend, but you're seeing that. And I do find that interesting, especially in the context of what has now been named in Wall Street jargon the debasement trade, which is the massive rally in gold and silver that you've seen over the past few months, and especially over the past month and week. We'll get into that in a second, but let's just round out fixed income. You've seen the yield curve shape change a little bit. twos tens went from 54 basis points last Friday to 53 now, so very very minor moves there. If you look at the front of the yield curve, you don't really have much of a change. You've seen a parallel shift across the curve pretty much. The 30 years down 6 bips, 10-year down 6, 5-year down about 6 or 7, and 2-year down about 6. So pretty much a parallel shift across the curve. When you're going to drill into the government's section as the best performing sector of the fixed income market this week, up about 0.5%, followed by mortgage-backed securities up about 1/3%. Corporate bonds, have a longer duration profile, meaning their cash flows come longer in the future, so they have more exposure to interest rate risk, and they're up about 0.1% on the week, whereas credit in the high yield portion of the corporate credit curve has sold off. It's down about 90 basis points on the week. Bank loans down about 20 bips, and emerging market bonds down about 0.5%. But on aggregate, you've been able to hide out in bonds in an investment grade portfolio. When we kind of shift gears and look at the commodity markets, at the aggregate level, the Bloomberg Commodity Index is down about 1% on the week, and that's mostly been driven by the energy sector, which is down about 3% on the week. The bright spot is precious metals up over 1% on the week. Drilling down, I mean, the big headline is gold. It punched above the $4,000 per troy ounce level this week. Currently, it's trading about $3,975 an ounce, but it's kind of consolidating around that 4,000 level. That was a big technical indicator, and that is once again, for all listeners out there, there's this new trade on Wall Street called the debasement trade, and the basic premise is, okay, a lot of these governments out there, their fiscal situation is not in order. That's in the United States and Europe and Japan, and these G7 governments don't have it together. What are you going to do? Well, if you don't have confidence in the governments and the central banks of those governments, where are you going to hide? Well, the debasement trade proponents are going to say you're going to hide in gold, silver, Bitcoin, alternative sources of value that are outside the purview of the government, that can't be manipulated in the traditional sense. Though, there's a long history of governments influencing precious metals markets, so that's just something to keep in mind. I mean, there's been investment banks out there saying that a significant portion of the rally in gold, and for example, if you have a price target of gold of 5,000, let's say, 2/3 to 3/4 of the demand for gold under that scenario, according to some Wall Street estimates, is going to be coming from central banks buying bullion. So, it's yet to be seen if the gold rally can kind of put in a support level around 4,000 and continue marching higher. But if it does, you can be sure that a lot of the demand is going to be coming from central banks themselves. So it's an interesting counterpoint to this kind of debasement trade, saying, oh, well, gold's rallying just because central banks are really falling apart. And you really have to interrogate that thesis and think about it. It's what's happening here. But it is interesting, and it's been topic du jour in the markets this week. Let's round out looking at kind of Bitcoin. Bitcoin currently is sold off quite a bit, actually, trading at 118,000. It had punched up over $124,000 of Bitcoin, but it's come down. So that's kind of an interesting contrarian indicator. And the dollar has rallied. It's trading at 98.9, so almost 99 on the dollar index. And that's another contrarian indicator, kind of being driven by this global risk off sentiment, and the fact that, there's a new political party that's taken power in Japan, and there's concerns over the fiscal situation coming out of Japan. So that's one of the drivers of that dollar strength, along with this debasement trade. So a lot going on in global markets. On the data side, though, with the U.S. government shut down, it's a pretty thin week. What do you have any other points to bring up regarding the tail of the ticker tape, Mr. Kimbrough, before we jump into the macro indicators that are on a diet because of the government shutdown?
Well, as you said, the government indicators being on a diet, I guess what we have to rely on is more of the micro level data, more of the company specific data. We start earnings next week for our equity companies out there, for our major corporations. So we'll see what that data reflects and see how we process that while we're kind of sitting on the sidelines with a lot of this macro data. But yeah, let's jump into our light week of macro data. It was already scheduled to be a very light week pre-government shutdown, but it got even lighter. So I'm going to run through a couple numbers here. On Tuesday, we got the New York Fed one-year inflation expectation number for September. This came in at 3.38% versus a prior of 3.20. Not something I normally would highlight, but it's a soft data metric that we can look at for inflation. You take this to some extent with a grain of salt. It's a survey. We'll look at some other inflation expectation numbers that are also survey data that are drastically different in terms of the results. But over the last few months, this number has crept up a little bit, and it's just something to keep an eye on when you're trying to holistically come up with your outlook on inflation. Moving forward to Tuesday, or on October 7th, on Tuesday, we also had consumer credit for the month of August. Maybe one of our better data points for this week, even though it's very, very far in the rearview mirror. But we'll cover this data. It came in at 0.36 billion this month. That was an increase in consumer credit by 0.36 billion versus estimates of 14 billion and a prior of 18.05 billion. Now, these numbers can be pretty volatile month to month, so I like to look at the rolling averages, 1 year, 2 year, 5 year, 10 year, just to get a sense of what's going on. And it all, it makes sense. Revolving credit growth continues to weaken. It's now at a new post-COVID low on a 1 year trailing basis. It's at an average of 2.85 billion per month. This makes complete sense when you look at actual credit card rates. The Fed provides this data monthly. Um, Credit card rates, the last few years have been north of 22% on average versus the last couple decades were more in the range of 12 to 14%. So rates go up and the borrowing goes down. On the non-revolving credit side within this report, thinking student loans, non-mortgage related debt, that's come off the lows. It actually hit a period of contraction on a 1 year rolling average a couple of years ago, and it's been inching back up. Still well below the rate of borrowing that we saw during the era of ZERP, but people, it seems like maybe are getting more accustomed, or the higher rates we're dealing with now are being a little more normalized. Moving forward to Wednesday, we got the FOMC meeting minutes. Actually, there wasn't a whole lot new in these minutes. You can just tell like there's some consensus building that needs to be done at the Fed. We saw it in the SEP with the dots. You had someone who was projecting one hike going forward. You had a handful that said no changes the rest of the year, and then some who were saying 1 to 2 cuts the rest of this year. So again, nothing much changed, but there was something in there I do want to highlight that I thought was nice to see. It's nice to get a bit of a peek behind the curtain of the Fed and see what they're talking about. And when they were debating labor data, they mentioned a number of other indicators that could be helpful in assessing the labor market. And many of these we already know, but I want to run through them just because the Fed was specific about them. They mentioned looking at the unemployment rate, no surprise there. The ratio of job vacancies to the unemployed workers. We usually refer to that as openings to the unemployed ratio. They look at wage growth, they look at the quits rate and the layoff rate. But the one that caught my attention that I hadn't seen before was the percentage of unemployed workers who find a job. And digging through some of the detailed labor data, you can look at flow data where it shows where people move from bucket to bucket, from unemployed to employed, from discouraged to employed, the number of permutations. But looking at that actual flow, you can see the number of people who move from unemployed to employed as a percentage of the prior month of people who were unemployed. And the number comes in around 25% on a 3-month moving average right now. There's nothing telling. It's nothing that's saying the labor market looks odd or bad, or it's anything worse than we already know. It's just another data point that the Fed said they're looking at, and they said in general none of them reflect a sharp deterioration in labor market conditions, but they're all risks they're considering. So I thought that was just an interesting tidbit from the meeting minutes.
I agree, and I think that the minutes, when I read through the minutes, I feel like it kind of had a somber tone. It was like scared doves is kind of the way I would characterize those minutes, because clearly they cut interest rates and there's a projection of them cutting interest rates again once or twice this year, but they're kind of just scared of inflation, and so there's vigilance there, but clearly there's dissent, as you mentioned, Mr. Kimbrough, and it's just maybe uncomfortable is the way that I interpreted the situation the Fed is in right now.
You know what? I'm pretty aligned with that. Like looking through historically, you have a lot more sections where it speaks to many of the participants having an agreement. And in this one, they would say, some sections of most participants thought this, and then they go into all of the other situations. But this small group thought this, and this group thought this, and a couple people thought this. So you can just tell that there's definitely a diversity of opinions going on there, and they're going to have to work through those. And Powell's going to have to corral them all, as we move forward.
On that point, since it's a light data week, since we're not going to have much for Thursday, we'll just talk about the interest rate probabilities. You know, if you look at the interest rate curves, the futures curves right now, I mean, the cut on October 29th is pretty much priced in as a lock according to the market. You know, the market is always wanting cuts, but that's pretty much priced in as a lock. And looking at those minutes, I mean, you think that absent a massive inflationary print, which interestingly, I know you'll touch on Kimbrough, but they're bringing back government workers to get that report out. You know, whether it'll be an accurate report or not, that's an interesting question. But that report is going to be published next week, despite the government shutdown. So that should give the Fed the ammunition to cut. I really think that there was some string pulling behind the scenes that they were like, dude, we need this information so we can justify our cut. And that's kind of the way I'm reading the tea leaves there.
I need to clarify something we talked about earlier. We may not receive it next month. They're calling them back and saying, like, before the month is over, you need to have this done. It's a kind of a scramble operation that they got going on, it feels like. But this is breaking news from this morning. Details are still coming out, so we'll see what happens. This was one person at the Fed reporting this, or one person who works at the BLS, I believe. So we'll see what happens there.
Tend to agree that it's a scramble, A, and B, looking at the interest rate curve, there's a cut priced in for October 29th, so we shall see if that comes through, but it's pretty much a lock.
Yep, that's what it looks like here. Look, let's wrap up the week real quick. Thursday, again, no data came out. We had the initial and continuing jobless claims. Initial jobless claims and continuing claims. Both those are not released due to the government shutdown. I will say, look, the last couple of weeks looked at estimates the week before, and no one's estimating anything crazy, but that doesn't mean much. So we'll see what we eventually get the real data. There was also wholesale trade sales and wholesale inventories for the month of August. Again, no data. But lastly, we get today, we had University of Michigan get released October prelim data. No real movement on the sentiment side. Small decline from 55.1 to 55. Maybe more importantly, you have their inflation expectations, similar to the New York Fed number I mentioned at the beginning. Soft data set. You don't put a lot of stock in it, but look, for the last 5 months, the 1 year number has come down. It's come off the May high that we saw of 6.6%. It's now at 4.6%. Again, it's drastically different than the number we saw from the New York Fed. So again, it's just to be taken holistically with all the other data we have. And the 5 to 10 year number, that is something the Fed has mentioned in the past. That came out at 3.7% in line with estimates and the prior. And that is our robust week of economic data.
Quite a diet this week on that data. I mean, next week though, very interestingly, I mean, looking out, I mean, you'll go over it, but you look out at it, and if the government shutdown continues, I mean, there's going to be very little that comes out.
Look, you got 2 big weeks of the each month. You got your your inflation week and your jobs week. I mean, those are 2 of the biggest weeks of your economic data. And upcoming is inflation week. We got CPI, PPI, and import prices, and all of those are scheduled to not arrive. So yeah, look, I can give you some estimates real quick. CPI on a core basis month over month is estimated to come in at 0.3. That's the same as it was last month. That would leave the core number year over year being unchanged at 3.1%. The headline is estimated the year over year to come in at 3.1%, up from a prior of 2.9. We also get the Fed releasing the beige book. We actually do get this because it comes from the Federal Reserve. On Wednesday, it's the 7th of 8 releases. It's just good qualitative data to read. We'll see what we get. On Thursday, we get retail sales. We do not get retail sales. It's supposed to come out, but we had retail sales for the month of September. The headline's estimated to be at 0.4% versus a prior of 0.6. The control group, what hits GDP, is estimated to come in at 0.3 versus a prior of 0.7. So again, we'll wait for that data when it one day comes. PPI year over year estimated to come in at 2.7 versus a prior of 2.6. And import prices estimated to be flat at 0.1% month over month versus a prior of 0.3. That no real impact on the year-over-year number. We're sitting flat with no real inflationary impulse from the import prices. And lastly, on Friday, we'll get some industrial numbers that actually come from the Federal Reserve. This is industrial production for the month of September, estimated to come in at flat, 0.0%. So not much expected there, but look, hey, maybe miracles can happen, but there's no expectation to be able to see this data next week. Right now, it's even if they come back, they still need time to put the data together. So we're on hold, and that's kind of where we're at, looking for other data sources.
Yep. I mean, like you just said, if the government doesn't reopen, we got a big week of the beige book and maybe industrial production, and that's about it.
Yeah.
So
Earnings. We got earnings.
Yep. That about wraps it up for this week.
Yes, thanks to our listeners out there. Today on DL Minutes, hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine on our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doubleline capital. We have Bill Campbell's Bloomberg TV interview up there. Jeffrey Sherman was on Bloomberg television this morning, so we'll have that up there. And I hope everybody enjoyed the episode and has a great weekend.
Yeah, thanks everybody. Stay safe out there and go Dodgers.